Okay, welcome to the deep dive. Our mission today, well, we're looking right at the razor's edge of the financial world. It's the start of Q4 2025, and we've got this huge stack of sources showing basically two completely opposite things happening at once. Record highs in some global markets, but also just immediate kind of stomach-churning political chaos right here in the U.S.
Yeah, it's really a period of intense cognitive dissonance if you're an investor right now. I mean, think about the contrast. You've got the European Stoxx 600, South Korea's Kospi hitting all-time highs. That reflects these deep growth narratives, mostly AI, right?
The AI story.
But then simultaneously, the U.S. government it just entered a shutdown. And gold. Gold futures closed near, what was it, $3,897.50 an ounce. That's a classic flight to safety.
Wow.
So yeah, we're going to be digging into where the real systemic risks might be hiding, and maybe more interestingly, how you can spot the hidden opportunities that this kind of chaos actually generates.
Okay, so we're breaking this down into four main parts for you today. First up, the shutdown itself, the immediate fallout, safe havens like gold. Second, that weird contrast in tech, this huge AI chip boom, versus, well, corporate efficiency drives, meaning layoffs.
Yeah, the two sides of that coin.
Third, we've got to look at the auto market, specifically the dynamics around EVs and this massive incentive cliff they're facing. And finally, we'll unpack the Q4 investment playbook. What are strategists saying? Plus, some pretty serious warnings coming out of the corporate debt market. All right, let's start with the loudest noise on the macro front, the U.S. federal government. First shutdown in almost 7 years, started October 1st, 2025. And the immediate impact isn't just about, federal workers being furloughed. It's about visibility.
That's the critical point, exactly. The shutdown causes an immediate, almost paralyzing data blackout. Think about the Federal Reserve. They've had a key meeting coming up late October, and now they're flying partially blind.
Flying blind out.
Well, they won't get the weekly initial jobless claims numbers. They won't get the really important non-farm payrolls report for September. When the Fed's trying to figure out the labor market, inflation pressures, losing that data is a major handicap.
And the political side feels, unusually high stakes this time around. Treasury Secretary Scott Bessent warned U.S. GDP could take a hit. But then President Trump countered, calling the shutdown an unprecedented opportunity, his words, an opportunity to cut what he called Democrat agencies, suggesting some of these cuts might actually be permanent, not just a pause.
Right, and that level of political instability, it's like rocket fuel for safety assets. It just drives investors toward gold. Gold futures closed near that record, $3,897.50. That's up nearly 50% just this year alone.
Okay, wait, up 50% already. Are we maybe seeing the end of that rally? Or is this just, the usual fear-mongering you get with political noise?
That's the key question, isn't it? The sources we're looking at suggest this is actually more structural, meaning you've got two major ongoing global conflicts, rising political instability everywhere, these newly announced tariffs. It all creates this kind of permanent uncertainty. So strategists, they genuinely seem to believe this is, and I'm quoting here, just the start of the strongest bull market in precious metals the world has ever seen.
Just the start. Really.
Okay, that's the argument. They point out gold is still actually pretty under-owned, barely 2% of the average investment portfolio. So for them, $4,000 gold isn't the peak. It's like an inevitability.
Okay, beyond the big markets, the shutdown's causing immediate real-world problems for people, especially anyone trying to close on a house. The National Flood Insurance Program, the NFIP, it's shut. Can't accept new applications, can't process new claims.
And that's where lending just freezes up. The National Association of Realtors warned this immediately delays closings because, lenders need that flood insurance to protect the collateral. They simply won't close if the property isn't insured.
So what happens?
Well, what's fascinating here is the immediate capitalist response. You've got Neptune Insurance, a private flood carrier. They saw this as the perfect window for their IPO. While the government program's down, Neptune is, quote, open for business. And get this, they offer coverage up to $7 million. The NFIP maxes out at just $250,000.
Oh, so the crisis creates a textbook private market opportunity.
Exactly.
Okay, let's shift gears from that political chaos to maybe the biggest engine of growth right now, AI. The AI mega trend. OpenAI just cemented its status. World's most valuable private company, now bigger than SpaceX. They just wrapped up a $6.6 billion secondary share sale. Locks in a $500 billion valuation. That number is just Staggering.
It is staggering. And the internal optics are pretty interesting, too. They actually authorized selling $10.3 billion, but only $6.6 billion sold. And the view inside the company is that this lower participation is actually a sign of high employee confidence.
How so?
They basically think the future value is going to blow past this $500 billion mark, so why sell now? And this confidence, it isn't just about the valuation number. It's driving some really serious infrastructure deals.
Right. These supply chain partnerships are enormous.
Yeah.
OpenAI's big Stargate initiative.
Yeah.
It includes this partnership with the South Korean chip giants, Samsung Electronics, and SK Hynix. And this is focused on getting more of those advanced memory chips, specifically HBM high bandwidth memory.
Absolutely vital for training these next-gen AI models.
Yeah. And they're also expanding data center capacity in Korea.
And the market reaction was instant. South Korea's Kospi index hit an all-time high, lifted by Samsung up 3.5%, and SK Hynix just surged almost 10%, levels they haven't seen since the year 2000.
So this one partnership really highlights how tied the U.S. AI boom is to, specialized Asian manufacturing.
Deeply tied. But, and this is the other side of the coin we mentioned, this massive spending narrative has an immediate counterpoint. Not all of big tech is going all in on growth over efficiency. If you connect this to the bigger picture, look at Google. They just laid off over 100 design folks in their cloud unit, including these quantitative user experience research teams.
Ouch. So cutting back even in cloud.
Yeah, this efficiency push seems to be about focusing every single dollar strictly on AI infrastructure, which, raises a fascinating kind of philosophical question about the progress AI is actually making. Hugging Face co-founder Thomas Wolfe, he injected a real note of skepticism recently. He argued that current AI models are actually unlikely to make truly novel scientific breakthroughs, like Nobel Prize-level breakthroughs.
Wait, why not? If they have access to, all the world's knowledge.
Because, fundamentally, they're designed to predict the most likely next word. That's their core function. And they tend to align with the person prompting them. Wolfe points out that real scientific breakthroughs are usually contrarian. They challenge the status quo. And AI built for alignment is kind of inherently unsuited for that sort of paradigm shift.
Interesting point. And speaking of constraints and maybe contrarian positions, geopolitical chip tensions are flaring up again. Taiwan just gave a pretty firm no to a U.S. proposal, pitched by Commerce Secretary Howard Lutnick. The idea was a 50-50 split in chip production. Remember, Taiwan currently meets, 95% of U.S. demand?
95%, yeah. And Taiwan's negotiator basically said, no thanks.
Right.
They stated the trade talks focus instead on lowering tariffs, which is, a strong defense of their vital strategic position. It really shows that despite these trillion-dollar AI valuations and the immense demand, that geopolitical reality, relying on one island for 95% of your most critical supply, that remains a massive unmitigated risk for the whole AI sector.
Yeah, a huge bottleneck. Okay, let's shift away from high-tech and debt markets for a minute and look at the consumer. Q3 2025, on the surface, looked fantastic for the auto sector, especially EVs. Ford, General Motors, Hyundai, all reported record quarterly sales of all-electric vehicles in the U.S. GM's EV sales more than doubled year over year. That sounds like, the tipping point for adoption has arrived.
It really does sound like that. But you have to look behind the numbers. The main driver, it was that $7,500 federal EV incentive ending in September. So consumers were actively pulling their purchases forward, trying to lock in that massive discount before it disappeared.
Okay. So just to recap that key point for everyone listening, Q3 was kind of artificially inflated by a deadline.
Pretty much, yeah. Which leads us to Ford CEO Jim Farley's, frankly, astonishing prediction. He said he wouldn't be surprised if EV market share fell from that record high of maybe 10% to 12% in September, all the way back down to 5% this month, October.
5%, that's a huge drop, overnight. That's a massive forecasted cut in consumer demand.
It really is. It suggests that for a pretty big chunk of the market, that $7,500 was the make-or-break factor, the difference between buying an EV and not buying one. And the long-term implications are, well, they're huge if demand basically halves overnight. It really calls into question the whole speed and scope of investment plan for charging infrastructure, battery plants, you name it.
So how are the car companies reacting to this sudden cliff? They must be doing something right now to bridge that gap.
Oh, they're reacting aggressively and creatively. Hyundai, they immediately slashed prices on their 2026 Ioniq 5 EV by up to $9,800, and they offered a $7,500 cash incentive on the older 2025 models. So basically a direct price matching strategy.
Okay, just cutting the price. What about GM and Ford?
They took a slightly different route. They used their financing arms, GM Financial, Ford Credit, to effectively extend that $7,500 tax credit, but only on leases. This way, they kind of protect their sticker price, the MSRP, while still giving the consumer that effective discount just through the lease payment.
Clever. Meanwhile, over in China, the dynamics look different but still challenging. Market leader BYD. They actually saw their first year-on-year sales decline in 2025, down almost 6% in September, and that's apparently amid just fierce, brutal price competition over there.
Yeah, the price war in China is intense, but what's fascinating is while the leader, BYD, is slowing down, demand for new affordable EVs seems to be surging. These Chinese upstarts like Leapmotor, like XPeng, they're setting new monthly delivery records, both up around 95% year over year.
95% how?
They're boosted by cheaper, newer models and also local incentives. It really shows that in China, the battle is being won on the affordability front right now, which is maybe, a preview of what the U.S. market might soon face without those big federal tax credits propping things up.
It's a sign of things to come, perhaps. Okay, speaking of balancing risk and opportunity, let's turn to how strategists are suggesting, we approach this final quarter. Jim Cramer's take was interesting. He suggests the biggest winners from Q3 might just keep inching higher, mostly due to institutional behavior fund managers buying them just to window dress their portfolios before year-end.
Yeah, that's pretty standard institutional behavior. You buy what's already worked well to make your holdings look good for the year-end reports. And those top Q3 winners, he cited AppLovin up 105%, Western Digital up 87%. I mean, those are certainly impressive runs. But Kramer's main caution is probably what we should focus on more. He believes the biggest gains for the year might actually be behind us already.
Right. He specifically warned against bottom fishing, trying to pick up stocks that have lagged. He mentioned used cars, the CarMax stock crashing after their tough earnings, managed care, cable companies.
Exactly. Those sectors are facing real headwinds. The only underperformer he really saw potential in for a rebound was, interestingly, Chipotle. So very selective. And this kind of cautious approach, it contrasts pretty sharply with the signals coming from the corporate debt market. PMCO is flagging some real stress there.
Yeah, PMCO specifically flagged cracks in corporate direct lending. And they mentioned borrowers are increasingly using payment in kind, or PI interest. Can you just define PI quickly for our audience and explain why it's such a flashing red light?
Sure. PI is a classic stress indicator in corporate finance. It basically means the company isn't generating enough cash from its operations to actually cover its interest payments. So instead of paying the interest with cash, they effectively borrow the interest from the lender and just add it to the total amount they owe, the principal balance.
So they're borrowing more just to pay the interest on the existing loan.
Precisely. It's literally kicking the can down the road by making the loan bigger. It sounds almost like, some kind of financial Ponzi scheme, borrowing to pay interest. But this happens in real corporate finance when companies are stressed.
Wow. That is a stark signal of stress in that corporate segment. So companies are facing a tough trade-off then.
They really are. They basically have to choose between expensive private funding, think private equity loans, direct lending, which is often easier to renegotiate terms on if things go bad, and cheaper, more liquid bank debt or public bonds. But with those, refinancing is trickier, and that can lead to very public defaults when problems arrive.
But PMCO did offer a bit of a counter-narrative, right? Something was healthier.
Yes. Crucially, they noted that asset-based financing, things like residential mortgages, consumer loans, that segment remains much healthier. And the reasoning is that households, generally speaking, deleveraged quite a bit after the 2008 financial crisis. Corporations, on the other hand, levered up.
Okay, so household balance sheets look better than corporate ones. That focus on consumer strength kind of leads us to the future of finance. Tokenization seems to be gaining serious momentum. Robinhood CEO Vlad Tenev called it a freight train, said it will eventually eat the entire financial system. And Robinhood's actually putting its money where its mouth is, offering tokenized U.S. stocks over in the EU already.
Yeah, tokenization is all about solving old inefficiencies. And we're seeing really practical use cases emerge now, like small businesses. The example given was Prevail Coffee testing stablecoins to disrupt traditional payment processors. Merchant processing fees hit a record $187.2 billion last year. That's a huge cost for businesses. Stablecoins potentially offer a near-instant payment receipt, cutting out middlemen, drastically reducing those crushing fees. That's a massive, tangible efficiency gain right there.
Okay, so we've covered a tremendous amount of ground in this deep dive. We looked at that safety rally in gold, driven by the political volatility, the high-stakes U.S. shutdown. We explored the massive AI valuation spikes, but contrasted that sharply with efficiency layoffs and those very real geopolitical supply chain constraints. And finally, we dug into that tricky, incentive-dependent path for the auto industry, especially EVs.
Yeah, and the synthesis across all these sources really presents a clear tension for you, the listener, to grapple with. On one hand, you have household balance sheets looking relatively strong, according to PMCO, and consumer sales just hit those EV records in Q3, even if incentive-driven. But on the other hand, corporate debt is definitely showing serious cracks. That PIK debt usage is a big warning sign. And overall, macro stability is clearly being challenged by this actively weaponized U.S. government shutdown.
So what does this all mean for you? Here's a final thought to chew on. If Ford CEO Jim Farley is right, if U.S. EV sales market share really does drop dramatically, maybe from 12% back down to 5%, now that those federal incentives are gone, does that predicted plunge in demand immediately translate into widespread pressure on that supposedly healthier asset-based lending segment? Remember, auto loans are a core part of that consumer loan market. So how resilient are those household balance sheets really to major volatility in big-ticket consumer purchases like cars? That's the question. Go explore that.